Welcome to today's deep dive. I'm so glad you're joining us because today is Friday, June 19, 2026, and, well, things are getting weird out there.
They really are. It's a strange environment.
Right. Because right now, if you look at your portfolio, the global stock market is just hitting all-time highs. Like, on paper, everything looks spectacular for you.
Exactly, on paper.
But at the exact same moment, the smartest institutional money in the world is quietly orchestrating like the largest financial exit we've seen in over a decade.
Yeah.
Someone is incredibly wrong here. And today, we're going to find out who.
That's the goal. We have a lot to get through.
We do. We've got a massive stack of sources for you today. We're pulling from market newsletters, deep dive data from Bravo's research, Benjamin Cowan's latest analysis, and even some rather alarming insider reports from the Ethereum ecosystem.
It's a really diverse set of data, but it all connects.
It does. Our mission today is to uncover the severe disconnect happening beneath the hood of both traditional finance and the crypto markets. Because the smart money, they're actively changing the rules of the game while everyone else is just distracted by the view at the top.
Right. They're looking at the scoreboard instead of the actual game.
Exactly. So, okay, let's unpack this. Because we have to start with the broadest picture possible, which is global equities.
You have to. You can't just look at crypto in a vacuum.
No, you really can't. You simply cannot understand the absolute apathy happening in crypto right now without first looking at the bizarre, almost broken state of the traditional stock market.
The broader market context is everything here, and what the data from Bravo's research shows us is a severe decoupling of historical metrics.
Decoupling how? Like, what are we actually seeing?
Well, right now, equities are climbing to fresh highs, but market uncertainty metrics are nearing a 40-year peak.
Wait, 40 years?
40 years. And historically, those two things are inversely correlated. High uncertainty usually means investors demand a massive discount for taking on risk, so, prices should drop.
Right. That makes total sense. High risk means lower prices.
Exactly. But today, they are completely divorced from one another. Stocks are up. Uncertainty is a paradox.
And when we look at where the capital is actually flowing, the picture gets downright weird. Institutional investors, hedge funds, the massive entities that manage systemic risk, they're running for the exits.
They're sprinting, honestly.
Yeah. Bonds are down 15%. Money market funds just experienced their largest monthly outflow in over a decade.
Which is a massive red flag.
It's huge.
Yeah.
And all of this capital flight is happening while corporate profits, the actual fundamental money these companies generate, have been completely flat since 2021.
Flat. No growth at all.
So the market valuation is surging, but the fundamental earnings haven't grown an inch in 5 years. It's like a skyscraper being built higher and higher, but the steel beams haven't been reinforced since 2021.
I love that analogy. That's exactly what it feels like.
But I have to push back here. If the smart money is fleeing and corporate profits are flat, who exactly is holding the bag? Who is keeping this illusion afloat right now?
It's a great question. You're basically touching on the mechanical reality of modern markets. The buyers keeping prices high aren't making active fundamental value judgments anymore.
So they aren't looking at spreadsheets and earnings reports?
Not at all. You are looking at the combined force of algorithmic momentum trading and passive index fund flows.
Wow. So it's robots and 401ks?
Basically, yeah. They are essentially playing a massive game of musical chairs.
Okay, tell me more about that. How does that game actually work in this specific context?
Well, in a healthy market, the music playing is corporate profit growth. But as you noted, that music stopped in 2021. The only reason the game is still going is that these algorithms are programmed to just keep adding more chairs.
Because the chart is going up.
Right. They buy because the chart is going up, and their buying makes the chart go further up.
A self-fulfilling prophecy.
Exactly. But Brabos points out a chilling historical parallel here. The last time we saw valuations completely detached from stagnant corporate profits and sky-high uncertainty was right before the 2001 crash.
Oh, wow. The dot-com bubble.
Yeah. The illusion is currently holding because profits, while completely flat, haven't drastically fallen yet. They're hovering.
So it's just suspended animation.
Basically. But the second those earnings take a real dip, the algorithms will reverse. And the downside volatility will be sharp because there is literally no fundamental bedrock to support these valuations.
So we have this massive game of momentum carrying the market, totally disconnected from reality, which forces us to look at the building inspectors of the economy, the Federal Reserve.
Right, the ones who control the music.
Exactly. Because if anyone is going to accidentally pop this, it's them. We just saw a major leadership transition at the Fed, And the tone from their first Federal Open Market Committee meeting was incredibly hawkish.
Very aggressive tone, yes.
But the broader market isn't buying it. Traders on Polymarket are only pricing in a 27% probability of an actual rate hike next month.
The market is absolutely calling the Fed's bluff. And to be fair, the data gives traders a reason to be skeptical.
Right. Because analysts are pointing out that the recent inflation spike was almost entirely driven by a sudden surge in global oil prices. But oil has already reversed.
Yeah, it came right back down.
Energy costs are cooling off. So what does this all mean? I really have to ask, if the inflation spike was just a temporary oil issue that is already self-corrected, why is the new Fed leadership coming out swinging with such a hawkish tone? Are they just trying to flex their muscles to prove they can be tough on inflation?
Well, if we connect this to the bigger picture, the Fed is staring at that exact same game of musical chairs we just talked about.
Oh, so they know about the skyscraper with the weak beams.
They absolutely know. They know the oil-driven inflation might be transient, but they have absolutely zero urgency to cut interest rates. Why? Because the massive AI trade is artificially masking the broader economic weakness.
The AI boom.
Right. Usually when the broader economy slows down, the Fed steps in and cuts rates to make capital cheaper, stimulating growth. But right now, the AI boom is driving mega cap tech valuations into the stratosphere.
So the Fed looks at the S&P 500, sees it at record highs, and basically says, why would we administer medicine to a patient who says they feel fantastic?
Exactly that. They have the breathing room to stay hawkish and ensure inflation is truly crushed. And this is causing chaos because traders have spent the last 15 years conditioned to expect the Fed to rush in with cheap liquidity at the very first sign of market weakness.
The famous Fed put.
Right. But that dynamic has completely changed.
And the fallout from that hawkish stance is sending immediate shockwaves into the crypto markets. Following the FOMC meeting, the US dollar has strengthened significantly.
It really has.
It's forming a solid technical base for further upside. And, as anyone who has spent time in these markets knows, a strong, high-yielding US dollar is absolute kryptonite for risk assets like Bitcoin.
Oh, without a doubt. Capital is completely agnostic. When an investor can get a 5% risk-free yield just by holding traditional dollars, the opportunity cost of allocating capital to a highly volatile, non-yielding digital asset becomes incredibly steep.
They just take the safe bet.
Exactly. Capital naturally drains away from the risk curves.
And that macro drain is colliding with some terrifying internal ecosystem panics. Yesterday, we saw STRC, a major, supposedly stable asset, sharply depegged down to $83.
That was a brutal drop.
Unbelievable. When a stable asset breaks its peg and loses that dollar parity, it shatters trust. It breaks the internal plumbing of the market because if a digital dollar isn't a dollar anymore, leveraged positions start getting liquidated left and right.
It creates a vicious cycle.
Right. So you have a strong macro dollar pulling money out and STRC instability causing sheer panic inside. It's putting devastating pressure on Bitcoin.
It's a textbook liquidity crunch, honestly. External capital is expensive to borrow, and the internal capital is suddenly viewed as contaminated risk.
And with the Fed boxed in by this AI trade, holding rates higher for longer, we're seeing an immediate, devastating casualty: the everyday retail investor.
The retail side is hurting the most right now.
Definitely. High interest rates mean cheap capital is gone, and the crypto ecosystem is being starved of its usual lifeblood. And the retail crowd isn't just sitting on the sidelines. They are actively abandoning the space.
The sentiment shift is measurable, and it is severe.
Let's look at the numbers from Benjamin Cowan, because they are absolutely bleak. Major crypto YouTube channels are currently bleeding 400 to 500 subscribers a week.
That's a massive outflow of attention.
To put that in perspective for you, back in 2021, those exact same channels were gaining 40 to 60,000 subscribers a week.
It's a total reversal of interest.
It is. And looking at the actual asset charts, it's a bloodbath. Altcoins from the 2021 cycle have fallen below their 2022 bear market lows. There is no fresh wave of capital masking the damage.
Not at all.
As a result, Bitcoin dominance, its percentage share of the entire crypto market, just continues to climb as people desperately flee smaller projects for the perceived safety of the biggest asset.
Cowan brings up a brilliant historical comparison to contextualize this pain. He notes that this cycle mirrors 2019 almost exactly.
The similarities are wild, aren't they?
They really are. Both 2019 and this cycle saw exactly 3 rate cuts, totaling 75 basis points.
Right.
And in both cycles, Bitcoin topped out just 2 months before quantitative quantitative tightening ended. When the Fed shrinks its balance sheet and sucks liquidity out of the system, speculative assets get crushed.
Yeah, the money hose turns off and the speculative stuff dries up first.
Exactly. But Cowen points out a harsher, more psychological truth about why retail is leaving. They walked away this time because the industry spent the entire last cycle chasing meme coins and hype instead of building actual utility.
People feel burned and exploited. And, I really want to emphasize how brutal this subscriber metric is for you. People aren't just bored. They aren't just ignoring the videos.
No, they're taking action.
Right. They are taking the active, intentional step to open their app, navigate to these channels, and hit unsubscribe. They're actively severing their ties.
It's a conscious rejection.
So, if retail only returned in 2020 because a global crisis forced the Fed into massive quantitative easing, and the Fed currently has zero reason to loosen policy because of the AI stock boom, are we just stuck in a ghost town for the foreseeable future?
The data strongly suggests yes, but it's vital to recognize that retail attention is a lagging indicator, not a leading one.
Explain that. What do you mean by lagging?
If you wait for the YouTube views to return, you have already missed the cycle. Social interest will likely not bottom out until much later this year. The demand side of the equation is going to remain low until two precise things happen. Monetary policy actually shifts to become accommodative, making capital cheap again, and internal ecosystem fears, like the STRC depeg, are fully resolved.
Okay, here's where it gets really interesting. Because while the retail investors are packing up and hitting unsubscribe, the massive traditional finance giants, the ones who usually mock this industry, they're actively moving in.
They are rushing in.
And they aren't just dipping their toes in, they are pouring concrete.
It is the defining contradiction of this market phase, honestly. The social noise is dying down, but the heavy infrastructural construction is accelerating at an unprecedented pace.
Let's run through the news on this because the institutional adoption is rapid fire right now. Morgan Stanley is officially proposing Ethereum and Solana ETFs, and they are doing it with an ultra-low fee of just 0.14%.
That is essentially a rounding error.
It's a massive loss leader. They are completely undercutting the entire existing market just to capture total assets under management.
They just want the volume.
Right. Meanwhile, Franklin Templeton has filed for a totally novel kind of ETF, one that automatically converts traditional stock dividends into Bitcoin exposure for investors.
Think about the mechanism of that Franklin Templeton product for a second. It creates a permanent price-agnostic buy wall.
Oh, wow. Because it buys no matter what the price is.
Exactly. It is an automated pipeline, taking traditional corporate yield and blindly buying Bitcoin regardless of market sentiment.
That's huge. And Fidelity just launched a specific money market fund designed exclusively for regulated U.S. stablecoin issuers. They are literally building the treasury management tools for these entities to park their billions and earn yield.
They're becoming the bank for the crypto banks.
Yeah. And this isn't just Wall Street paper products either. It's happening directly on chain. Base, the Layer 2 network, is activating its massive barrel upgrade next week on June 25th.
That's a huge technical milestone.
It is. They are introducing a native B20 token standard, which is essentially the Layer 2 optimized version of Ethereum's ERC20, designed for massive microtransaction volume. More importantly, they're enabling much faster capital withdrawals back to the Ethereum mainnet, which institutions absolutely require for capital velocity.
They need to be able to move money fast.
Exactly. So it's a wild irony for you to consider. YouTubers are bleeding 5,000 subscribers a week, but Morgan Stanley is grinding out 0.14% fees to capture institutional billions. The adults are quietly building the heavy-duty pipes, while the retail kids have officially abandoned the playground.
What's fascinating here is the complete divergence in time horizons. The institutional long game does not care about YouTube subscriber counts or what meme coin is trending on Twitter.
Not at all.
They care about two things: cheap accumulation while retail liquidity is absent, and laying down regulatory compliant infrastructure. They are utilizing the silence of this ghost town to build the toll roads.
And when retail comes back?
When retail eventually does return, they are going to find that Wall Street owns every single entry and exit ramp.
Wow. But there is a glaring, almost absurd contradiction here that brings us to the final piece of source material today. Wall Street is building these massive front-end toll roads to sell crypto to the masses. but the actual decentralized highway they're paving over, it's going broke.
This is where the decentralized ethos crashes headfirst into the grim reality of open source economics.
Yeah, we have a stark warning from former Ethereum Foundation contributor Trent Van Epps, who says Ethereum is facing a looming core development funding crunch in the next 3 to 9 months.
There's serious crunch.
The Client Incentive Program, or CIP, officially ended in April 2026. This was the program that funded the client teams, the actual developers, writing the software that the nodes run on. And there was no replacement plan announced.
The financial pipeline that sustains the base layer simply shut off.
Just shut off. Van Epps lays out the math for us. Ethereum's core development ecosystem requires roughly $30 million a year to operate. That money funds the client development teams, the research groups, long-term scaling efforts, and vital cryptographers working on quantum resistance.
All the stuff that actually makes the network function.
Right. But the Ethereum Foundation is actively reducing its spending and losing high-profile leaders. Van Epps argues the foundation was never designed to be the permanent centralized caretaker of a decentralized network. Wait, I have to stop here because this is genuinely blowing my mind.
It's a tough pill to swallow.
Ethereum secures hundreds of billions of dollars in value. Morgan Stanley, Fidelity, Franklin Templeton, they're managing billions of dollars on top of this exact network. How can the Ethereum ecosystem possibly be struggling to scrape together $30 million a year?
I know, it sounds crazy.
That is literally a rounding error for the institutions we just talked about. Why don't they just pay it?
Because you are looking at the ultimate tragedy of the commons. Maintaining one of the world's largest open source blockchain networks requires immense, highly technical coordination. But writing client software or researching quantum resistance isn't a profit-generating enterprise.
It's just maintenance.
Exactly. It doesn't yield a token you can sell to retail. In traditional tech, a massive corporation like Apple or Google pays for their own research and development because they own the proprietary intellectual property.
Right, they get to keep the profits from the patent.
Exactly. But nobody owns Ethereum. So an institution like Morgan Stanley, legally and financially, cannot justify spending $30 million of shareholder money on public infrastructure that their competitors can use for free.
Oh, why?
They can only monetize the wrapper, the ETF. They aren't structured to fund base layer public goods.
So they just extract the value and assume someone else will pave the road for them.
Yeah, precisely. And without stable, reliable funding, Ethereum faces a massive brain drain. Highly specialized cryptographers and developers are expensive. If they aren't funded, they will leave for highly capitalized, centralized tech companies.
Which makes sense. They need to get paid.
Right. And you risk losing years of irreplaceable institutional knowledge, drastically slowing down the vital security upgrades the network needs to survive long term.
So we have a system where billions are flowing into the centralized financial products on top, but the engineers keeping the actual decentralized engine from exploding are facing a budget crisis. That is incredible.
It's the paradox of open source finance.
Let's pull all of this together because the picture we've painted today is pretty staggering. We started with a traditional stock market that is soaring to new highs, completely propped up by algorithmic momentum and the illusion of flat corporate profits, while the smartest institutional money quietly runs for the exits.
It is a market completely decoupled from foundational reality.
From there, we looked at a hawkish Fed that refuses to cut rates because the massive AI tech boom is masking broader economic uncertainty.
Right.
That structurally tight money has starved the crypto markets, leading to a massive measurable retail exodus where everyday investors are actively severing their ties after years of meme coin burnout. Retail attention is lagging, and right now it's a ghost town.
But a ghost town undergoing massive institutional construction.
Exactly. The Wall Street giants Fidelity, Morgan Stanley, Franklin Templeton, they are aggressively utilizing this quiet period to build permanent, automated, low-fee infrastructure to capture future volume.
They're laying the pipes.
And yet, right at the heart of this transition, the foundational layer of this entire new digital economy, Ethereum, is facing a $30 million funding crisis because the traditional financial giants building the toll roads have no mechanism and, frankly, no desire to pay for the open source public goods that keep the highway running.
Which leaves us with a critical, almost uncomfortable question for you to consider as you watch these markets evolve.
Let's hear it.
If traditional markets are teetering on a profit illusion, waiting for a catalyst to fall, and decentralized networks are simultaneously running out of the public goods funding required to maintain their independence, What happens if both systems are eventually forced to rely entirely on Wall Street for their survival?
That is a terrifying thought.
Will the decentralized future you were promised end up being funded, maintained, and ultimately owned by the exact same traditional financial giants currently fleeing the traditional stock market?
It certainly makes you wonder who is really going to hold the keys to the penthouse when the dust settles on this transition. Thank you so much for joining us on this deep dive. Keep questioning the surface level narratives, keep looking at the foundation, and we will catch you next time.